In the world of investments, there are some principles that have, in the long run, provided higher rates of returns. Say, Warren Buffett and Charlie Munger have not been much more intelligent than other people, but they have been more disciplined and more focused and especially more patient than other people. And their philosophy was always to buy assets when their market price was selling at a discount of the intrinsic value of these assets. Say, you have property companies. The property companies, they have a value, a net asset value, but the property stocks, they frequently drop way below the value of the existing properties. And at that stage, they become attractive. Similarly, growth stocks, they occasionally become attractive, like technology stocks in the early 1990s were very cheap, or technology stocks in America in the years 2003, 2005 were cheap because investors at the time were focusing on other sectors and the Nasdaq had declined by 70%. But this is not the case now. Now, technology stocks must deliver miraculous returns to justify their valuation. Miraculous. And I can tell you, in technology and in everything, you'd always be surprised how many new technologies come up and compete with the existing technologies. So I wouldn't touch a single Magnificent Seven stock, not one. I don't have anyone, but I want to remind my readers that, or viewers, that when the asset markets go up, everything goes up, but some assets go up more than others. When the asset markets go down, the tendency is for everything to go down, but with some assets going down much more than others. So now I can argue, well, in this environment you should own gold. Yes, but I tell you, if the asset markets go down meaningfully, gold will probably also go down, but less than the other assets. Or value stocks will also go down, but less than the others. We never know precisely in advance what the catalyst could be. But I can tell you, if I look at all the potential wars that we have, I look at, say, nobody in the world and even experts in real estate expected commercial buildings to collapse in the US by 50%. Nobody expected that. And it happened. And I know many people who are involved in real estate. They're billionaires. They own properties in like incredible quantities. But it happened. And you never know why. And I'm not saying the US market will go down by 50% in nominal terms, but I think it will go down at least by 50% in real terms, inflation adjusted. That I'm quite sure about. Minimum. When the Japanese market was 50% of the world's stock market capitalization in 1989, I placed many bets, including in put options, that the market in Japan would drop by 50%. I was much too conservative. It dropped by 70%. The US has also a debt problem, as have all the other democracies in the Western world. But the debt problem is, of course, much larger than what is told by the media to the public, because they never talk about the unfunded liabilities. The unfunded liabilities are astronomical. And when you consider the fiscal deficit in the US, now, you just look superficially at the policies of Kamala Harris and Donald Trump. Both of them will not reduce the fiscal deficit. In fact, under both, I would expect the deficit to go up for different reasons, but under both, it's likely to go up. And the Fed will now cut rates. The big question is, of course, on the cut of interest rates coming now in September. Is it 0.25%, 0.5%? What will the impact be on the bond market? Because I'm long bonds. And I have been recommending bonds for the last few months because they became very oversold as of April of this year. And so they've rallied now 10%, long-term bonds. But interest rate cuts will undermine my confidence in the bond market. quite frankly. And it undermines my confidence in the US dollar. It's not that I have a lot of confidence in the US dollar anyway, but as a bond owner and as a dollar owner, I want tight money. As a stockholder, I want money printing. Understand? Now we're at the juncture in asset markets where different people will benefit. Not everybody will benefit. And the Fed is in this very difficult position that they know the markets are high. They know that people can't afford to buy homes. There's an affordability issue. Kamala Harris will make the affordability issue even worse by subsidizing home buyers. I mean, the economic policies of both candidates, in my opinion, are disastrous, but of course much worse in the case of Kamala Harris. Much worse. I've argued for years and years, and I've written a book about the rise and the fall of cities, because if you travel the world, it's remarkable how many cities have vanished. They disappeared. They were thriving cities. And how many cities that were the center of the world. For a long time, Venice was the commercial center of the world in the Mediterranean world, not in the Chinese world. But it was a very important trading center and cultural center and political center. What is the value of Venice today? It's a museum, an open-air museum. It's a wonderful city, but it has no political power anymore. Ditto for Rome. Rome controlled most of the world between, say, 200 BC to roughly 300 AD for 500 years. The Roman Empire then migrated to Byzantine, and they controlled a large portion of the world until 1453. The idea to introduce price controls in the year 2024 is absurd, because it's been tried so many times and each time the results have been disastrous. You can go on YouTube and just click in the search engine Milton Friedman. There is an interview of 3 minutes. Every investor should just listen to this 3 minutes interview. He won't waste his time for 3 minutes. And he explains exactly why it doesn't work. But Kamala Harris, she's clueless. Clueless. That is the danger of her being president. But I always say, whatever you have in the world today in terms of quality, whether it's Justin Trudeau or in New Zealand, they kicked her out, but this Jacinta before, and in Germany, Baerbock, Scholz, Habeck, are all completely ignorant and at the same time arrogant people. That is the danger. Their arrogance, their interventionist intentions. The market functions best. The capitalistic system functions best when it is left alone, and not when politicians who never worked a day in their lives, they never worked in a business, have no clue what hardship the small businessman goes through, and has to fight against the government for everything, because the government officials, they don't care whether the small businessman survives or not. And the politicians, they don't care about the small businessman. They care about the rich donors. That is the fact. But the Wall Street economists, they will never tell you this, because they're all afraid to lose their jobs. That is the problem. People have become enslaved by the system. They all need their jobs. They're afraid to lose it. They're not free agents anymore. And half of them are paid by the Federal Reserve or bribed by some other organization. So they don't tell you the truth. If you look at the demand side of the real economy, it is poor. So based on the real economy in the world, which hasn't recovered back to the 2018 level. If you look at the statistics of Asian economies, none of them has recovered the 2018-2019 level. So the demand side is weak. Also China is weak, the demand in China. And it's 50% of demand for commodities in the world, approximately. But the financial markets are in the sky. So what you have, a negative impact from the real economy on commodity prices, but a positive impact from the money printing that is still going on. No matter what the Fed tells you, you could have interest rates at 20% and money wouldn't be tight. The absolute level of interest rates does tell you nothing about whether money is tight or not. In Turkey, they had 100% interest rates and money was loose. In Argentina, the same. So we have to be very careful. We have two conflicting forces. The global demand is pushing commodity prices towards the downside. But the money printing and the forthcoming money printing, I tell you, the Fed has no other option but to print. They must. They don't want to destroy the asset markets. So that will be supportive of some commodities. We have some commodities that are up strongly. Coffee 37% plus this year. I want to be very clear about the bond position. My bond position is a tactical short-term trade. I'm still holding the bonds, but I'm concerned that on rate cuts, the Fed is cutting too soon. They shouldn't cut from a financial point of view and from an inflation point of view. So my bonds, I will reduce the positions within the next 2 months. But I've been buying and holding gold for the last 40 years. My concern about gold is governments are so bad and so arrogant, and they locked in people in their homes and you couldn't go out and you had to take vaccines. I mean, I grew up in a school system where people were told, oh, democracy means freedom. It's nonsense. Democracies don't mean freedom at all. Otherwise, we wouldn't have censorship about everything you say. I mean, it's unbelievable. Now they locked in a Russian in Paris. He's been released in the meantime, but just to say the day can come where they lock in Zuckerberg, all these businessmen, who knows? And holding gold, you never know when the government will come and say we have to collect the gold, like they did in 1933. I don't even value the gold I own, but if I look at the characters that are at the Fed and at other central banks, I have no confidence at all in their ability and their willingness to see to it that paper money is a store of value. This is a very important function of money. It should be a store of value. I do not think that any central banker today is like Paul Volcker, who had the courage and the prestige to actually restore paper money as a store of value. I define paper money as a store of value if interest rates in real terms, inflation adjusted, are relatively high. And I regard paper money to be a dishonest currency if the interest rates are below the rate of inflation, which I think at the present time in most markets we have interest rates that are too low, should be higher. I don't think that since the time of Paul Volcker, the Fed has ever done anything right. But to be fair to Alan Greenspan, who is frequently, targeted by critics, Alan Greenspan, he had the courage to increase the Fed fund rate in the late 1990s to 6.5%. And the rate of inflation at that time was much lower than it is now. Number two, he also increased interest rates too slowly and not enough, but he increased interest rates to 5.5% in 2007, 2008. Afterwards, they slashed the interest rates. By then, Mr. Greenspan didn't care much about it anymore and listened to Ben Bernanke, who is the money printer par excellence, number one in the world. He went to the economic school of Zimbabwe, which was at the time run by Mr. Mugabe. That is the school of Mr. Bernanke. I urge viewers to pull up a chart. They can go on Google it. Interest rates in the 1970s. And you will see the first peak of interest rates was in 69, the second one in 1973, and so forth. And after these peaks, interest rates fell by roughly 50% each time. And they kept on going up for 10 years. In my view, we will see in this cycle, which interest rates and inflation move in long-term cycles. The long-term cycle peaked out in terms of interest rates in 81 when 10 years treasuries were over 15% and bottomed out in May, August 2020. Since then, we are in a secular increase in interest rate cycle that may last 20 or 30 years. And in this cycle, the interest rate will go to maybe 100% or 200%.